The morning after the afternoon before. European markets taking a much more positive view of the crisis-fighting measures outlined yesterday by ECB President Mario Draghi. I'm Jamie McGeever and this is today's Market Pulse. Well, joining me today is Lena Komileva. She's Managing Director and Chief Economist at G+ Economics. Lena, some pretty big moves today in the market, particularly at the short end of the Spanish and Italian bond curves. How long can this continue?
I think this has some way to run, Jamie, given that I think that Draghi's announcement yesterday perhaps caught some of the analysts in the markets with their trousers down. So it's taken a little bit of time for the words to sink in, for the implications to be understood. I've been calling for the ECB to start buying 2-year Italian Spanish bonds for the last 5 weeks, and I was really pleasantly surprised that the ECB should come up with such a bold plan in August. I think what's likely now is that we're going to get the details of the program of SMP2, if you like, the upgraded program for the ECB over the coming week. And that will pave the way for the launch of bond purchases optimistically before the end of this month, but I think more realistically in September. Once the cash hits the market, we're going to see that steepening of the yield curves go some way further, I think.
OK, but that's the short end. Yeah. The long end, on the other hand, obviously is a bit stickier. Will those yields start to come down as well, do you think?
Well, I think when we start seeing bullish flatteners in the Spanish and Italian yield curves, we will start to know that the current strategy, the EU's current strategy of tackling the crisis is beginning to bear fruit. It's too early to expect that. Having said this, there's of course a correlation between short-end and long-end yield levels. What that means is that, let's start from the beginning. Weak sovereigns in the Eurozone have one disadvantage that weak sovereigns like the UK and the US outside the Eurozone do not have, and that is that they run the risk of a sudden stop of market liquidity. This risk has been inadequately addressed so far. I don't think that an ECB announcement of a rate cut or LTRO yesterday would have made any difference at all to the fact that the current strategy has not been working. Once this liquidity risk premium disappears from the short end, we're going to see a benefit for the long end as well. Having said this, I don't expect a flatness. In other words, I don't think that the long end can disproportionately benefit versus the short end of yield curves until we see this time bought with the liquidity directly from the ECB into the short end of capital markets, government bond capital markets along the strategically important periphery, that's Spain and Italy, begin to work. Yeah,
OK, well, we may have a few weeks to wait for that, as you said. What about the euro? It's recovering some ground today, but surely what Draghi wants and what the Eurozone needs is a lower euro.
That's right. I think that the reason why the euro is recovering ground, and I do expect it to go firmer in the short term, actually, as the implications of the ECB announcement sinking deeper in the market psychology. And that is that what the ECB is doing here is, for the first time, it's actually dealing with the causes rather than the effects of illiquidity in bank capital markets, in money markets, and in government bond issuance, primary markets. What that means is that as fears about euro disintegration disappear, with the ECB's balance sheet now going directly to plug in the balance of payments deficits along the periphery that have been the cause of concern about an ultimate euro disintegration, a realistic concern in recent weeks. We're going to see some, at the very least, a removal of incentives for investors to exit the short end of those yield curves, or to worry about irrational illiquidity leading to direct insolvency concerns. As that momentum stabilizes market psychology, we're going to see the flows that have been behind euro weakness in recent weeks abate, and for that reason I expect the euro to be a little bit stronger. But wait until the ECB begins bond purchases, because the one question, remarkably, that the ECB President Draghi left open yesterday was about sterilization. Now, I've been thinking that if the ECB has no deflation concerns to back its open market operations in terms of purchases of 2-year government bonds in Italy and Spain, then it will have to somehow neutralize these effects. Now, when it's running unlimited MROs in the banking system, it's very difficult to really do that. It can do this artificially, but it will have no meaningful effect on expectations, rightly, I think, that the ECB is looking at a form of QE here. Okay. What the ECB can, however, do is try to recycle some of the liquidity from the short end of the German yield curve into the peripheral markets, which will help neutralize. But unless this happens, the euro can actually start dipping lower into September as the ECB begins purchases.
Okay, and just to finish up very quickly, Lena, a Reuters poll yesterday after Draghi's press press conference, gave him a 7 out of 10 for his performance. What would you give him?
I gave him 10. 10 out of 10.
10. Gold medal for Mario Draghi. Lena, thank you very much. Well, on to technicals now, and ahead of the US non-farm payrolls report, today's chart of the day is the S&P 500. Credit Suisse's David Snedden explains why, despite the economic gloom, there's still plenty of appetite for risk in US equities.
The S&P is very interesting because until about a month ago, we had the risk-off trade was very well correlated in our view, that we had a lot of assets moving in the same direction. And that started to change over the last month, and we had bonds and FX clearly being part of the risk-off trade, but equities and credit really acting very differently and in a sense being risk-on. And we've seen the S&P, which I think has rallied up to the top end of its big range, and the big resistance here, 13, anywhere from sort of 1385, 1395. I think given how immune it's been, it's still at the moment a rally within a bigger sideways range, and to start to suggest we're ending that range, you probably need to see the cash market above 1400. If you can do that, I think we can certainly go back to the 1420 high. And the other thing I think is interesting in the S&P is, to me, the pain trade for this market clearly seems to be higher. So again, 1390, 1400 through the rest of this week is going to be a very major test to see whether it's still in a sideways range or starting a more sustainable up move.
That's it for now, and that was Market Pulse. I'm Jamie McGeever. This is Reuters.